Welcome back to U.S. Farm Report right here from Commodity Classic. Talked a lot about tariffs, of course, a lot about trade, a lot about the potential impact there. But Jared, as you look at the turbulence and the volatility in this market today, what other options do growers have to navigate that?
Well, to start with, tying in the prior segment, you asked about setting a February high. I'm unwilling to go this far yet, but I think there's a need to consider that our seasonals in the markets have changed. We're no longer talking about an April, May, June, July seasonal based upon North America. Rather, maybe that seasonal is December, January, February based on South America, given the global world trade flows. Now, what does that mean to the U.S. producer? It's not all that bad. Maybe it just means that the marketing plan has to be moved up a couple months. And one of those things of getting the price set in the month of February for crop insurance. This is a conversation that every single U.S. producer, specific to corn and soybeans, needs to have with their crop insurance agent, given the recent subsidy increase for the Enhanced Coverage Option, ECO. It doesn't matter what state an individual's operating in, it functions the same everywhere, and there is no things are different here. It's priced the same everywhere you go. In theory, given a producer coverage from 95 to 86% of the county on top of their own multi-peril policy, and the government's paying 65% of that bill. Okay. There is a profound reasoning that a huge percentage of U.S. acres should be using that.
Chip, do you want to add something to that?
You know, the more things change, the more they stay the same. Your basics for your risk management are crop insurance. Get started there.
Trends in global carryover, what do farmers need to take note of right now, Chip?
We're on corn and wheat, we are consuming more than we're producing. You know, 2 out of the last 3 years, something like that. That's a good sign globally. Soybeans, we are producing more than we're consuming on a global basis, and we're building that global carryover. That's the wet blanket on beans, I think, is the big issue. Corn and wheat, I think that's part of the reason why if we do have a weather problem in South America or we do have a weather problem in the U.S., that's why corn and wheat are going to be sensitive to that issue. Beans, maybe a little less sensitive.
We got our first look of acreage from USDA's Ag Outlook Forum. Of course, that wasn't survey-based, but 94 million acres of corn. It seemed to catch some by surprise. I mean, talking to you guys, it's not really that surprising. We knew we were probably going to plant more corn. But as we get the prospective plantings report at the end of this month, Chip, what would shock the market?
I think 2 things. 5.5 million more corn acres would shock the market. Only 2.5 million more would shock the market. I think 3.5, 4 million is pretty much baked into prices. I would just caution everybody, it doesn't matter if we plant 97 million, we still have to have the weather and grow the crop. And so at the end of the day, Mother Nature still is in charge here.
Mother Nature is queen. But today, you look at the cost of production and the variance, Jared, that you're seeing. How is that playing into farmers' acreage decisions right now?
Well, I believe in North America, especially in the heart of the Corn Belt, that the cost production difference between corn and soybeans is somewhere between $200 to $250 an acre. It's substantial. And given that, I would challenge the belief instead of how high can the corn acreage number go, we probably need to consider that the corn and soybean pool of acres is going to be closer to 180 million instead of 178. And with that, it's still going to take good, timely planting. We're probably going to need to be over 50% planted of the national corn crop by May 10th, give or take. Yeah. And in the event that happens, that's just maybe one more step for the market to take a little bit of risk premium off the table. You know, to Chip's point that right now we can not really source a lot of the demand for the world, but at the end of the day, it's not like we need 95 million acres. It's not like we certainly need 97, 98. And just to keep in mind that we have had a history of March planting intentions be as high as 97 or 98 million acres, and it matched up with what the ratio of corn and soybeans are today.
Real quick, Chip, what do you want to leave farmers with, real quick?
Times are tough right now. We're going through some issues that we're going to have to deal with. We get that. We'll come out the other end of this okay. We just got to give it some time.
Chip Nellinger.
Yeah, again, crop insurance is your backstop, but think 2 or 3 steps ahead, right? What is the market not thinking about right now? And that's a weather scare either in Brazil or here. Yeah. What are you going to do when the rally comes? There's a lot of things to do.
Jared, real quick.
Things are tight enough that this isn't necessarily an environment where we're focused on trying to get a big return on the farm. The big returns on the farm will come with what both these gentlemen just said, the next boom. So it's keeping things tight, keeping working capital good, keeping equity, making sure we're there to survive or thrive in 2025 continues to be a common theme.
All right, we need to take a quick break, and then we will have much more right here on U.S. Farm Report.